the chapter The Third Way. As you said very correctly, he's neither a trend follower nor a counter-trend trader, but his process is really to find patterns in the market, and that is what he does.
Well, let me ask you, because I've got a couple more guys and some big picture principles I want to run over. But what? Let me ask you, as the guy that goes down this path, and there was a certain amount of time between this book and your last Market Wizards books. What were some of the things that you would want to be asked about? That I mean, obviously it's in the book. There's a tremendous amount of material in the book and your own views too. But what's your big takeaway? How did this change you? How did this book change you? How did all these interviews change you?
That's a good question. I can give you, well, let's see what I can think. I can think of one comes to the top of my head. I'm sure there's more than one way.
Putting you on the spot, Jack. Putting you on the spot.
No, that's fine. That's great. Keep you from falling asleep. That's good.
Oh, come on. I wouldn't let you fall asleep.
No, I'm teasing. You're actually asking very good questions. So it's an interesting interview for me too. And that's good. I'm enjoying it. So that is an excellent question. So how did it affect me directly? I'll give you a good example. Jimmy Balladine is a trader I talked about before that my son apprenticed to. And well, his style of trading, we may as well go into it here. And he's probably talking about first, of all the books I've ever written, he is the most different trader of anyone I've ever interviewed. And as I begin that chapter with a line that I think is very apropos, and it's also one I think one of the better opening lines I have for any chapter I've ever written. It's a very short one, and it's simply Jimmy Balladine breaks all the rules, and he does. And he sells into rallies. He doesn't use stops. He does things that are really reckless or seemingly reckless, but yet he makes money year in, year out. And I actually, not facetiously, even semi-facetiously, but also seriously, in the conclusion of that chapter, warn people that this chapter should be looked at like those late night infomercials where, don't try this stuff at home. So having said that, though, one of the things he does, and one of the ways he makes money, even when he's wrong, is he's constantly trading around positions. So he has, these months, like when I went to interview him, the 3-4 months before I interviewed him, the market was up every month. He was short every month, and he made money every month. Or he broke even, but he didn't lose much. And the reason why that was true is because he's always trading around the position. So if he's short, the market goes down, he takes some. It goes down more, he takes some more. It goes back up, he resells it. So he's constantly making money trading around his positions. And I kind of believe in the idea of trading around positions anyway, but I think seeing the power of that, the way he's applied it, and understanding that even when you're wrong, if you do that part of it well, you could still end up ahead, was, I think, an important influence. And I think it influenced me to do more of that in my own trading, to be more inclined to take some off when it's going my way, and put it back on. And one interesting thing about doing that is, if you think about it, it's going to help you. When is it going to help you? Well, it'll help you when the market goes into a correction. Well, you'll pick up some money that you wouldn't have. It may also help keep you in the trade, because if you're picking up money on the correction, you actually are happy when it's going against you, because then you can put the position back on. So instead of getting out of the whole thing, you're actually putting it back on. So it's very beneficial in those type of cases. Where is it going to hurt you? Well, it's going to hurt you if you take some off and it keeps on going. Well, what does that mean? That means that you've made money on the rest of it, so you make less of a windfall profit. And I like that trade-off. I like the idea that you're doing something in trading where it's going to help you when you would have been losing, and you're just going to give up some money when you would have been making more. I kind of like that trade-off. So I found that kind of an influence. It wasn't something that I had never done or anything like that. It wasn't a sudden insight. The insight was more understanding the power of it and getting a better appreciation for that as an approach. It is also, if you think about it, a way where you could be sort of not wrong necessarily on a trade, but let's say you go long or short and the market ends up chopping around, doesn't go anywhere. If you're doing this, you could actually end up making money on a trade where the market doesn't go anywhere from beginning to end, because you're selling someone that's going your way and then putting it back on when it comes back. So that's a good example of how there was an influence, but it's not certainly the only way. A lot of these traders definitely have had an influence in things they said ringing true, and maybe reinforcing just things, even if I already knew them.
Jack, overall, the gentleman in this book, is it a fair assessment to say, self-starter, entrepreneur types, really not silver spoon guys? A lot of these are just self-made men.
I think so. If you think about all these people, and I'd have to go one by one, but almost all of them that I think of really came from, they didn't come from wealth. A few of them did come from upper class backgrounds, to be sure, but most of them really didn't, and some of them came from really, almost poor backgrounds. Thorpe grew up in the Depression, as an example. Clark, a poor working class family, that type of thing. So those are probably more representative of the backgrounds of these people. Very few really had any money when they started.
Well, let me. I know I mentioned early on that there are some very large names in here, and so just to whet the appetite of folks that are listening to this. So your second chapter is about a guy who, as far as I can tell, is the man when it comes to making gross money. I think you say he's made $50 billion for investors over 20 years, and we're talking about Ray Dalio at Bridgewater. So let me ask you, without going into and sitting here like I've done before on some of these other traders, what can you tell us about Dalio, your lessons, your insights, what you took away, some feeling that perhaps isn't really in the book, something that we're talking about the gentleman who is really
estimated time in traffic 7 minutes.
Amount of wealth, it's hard to count. So what can you tell us that's not out there floating in the ether already about this gentleman?
Well, there's a couple of things. For one thing, let me just say, in terms of his accomplishments, you have records out there like Joe DiMaggio's that maybe never get broken. And if I had to say of all the traders I interviewed, what record will never get broken, well, Thorpe maybe on his number of winning months, percentage of winning months. But Dalio has done one thing that I think it's almost inconceivable that anybody could do again, and that is having a huge percentage year, and I forget what it was, like 30% or whatever, it was some very large money, managing $50 billion. You would have asked me, a few years ago, before you ever did that, I would have thought it would be hard pressed to even make money managing that much money. It seems like such a huge disadvantage. But to be able to make a huge return managing a giant sum like $50 billion, that is like one of the most incredible feats that have ever been achieved.
And nearly systematic to add, right?
He's systematic here, but systematic different from what other people think is systematic.
Absolutely. Save that for the read. They'll have to read about that.
Well, yeah. Well, we can tell them. We can say here that's systematic without technicals. Really.
Yeah.
So
it's very interesting.
Dalio is very opinionated. He knows what he thinks is right and where he wants to go. And I think like a lot of great people have that quality. Steve Jobs in a different field. Sort of the visionary people have that self-assurance and understanding. One of the important things there's a number of things that I won't go into all of them, but one thing I think is important that Dalio brings out is that markets behave differently in different environments. So if you look at markets, and I'm speaking now fundamentally, not technically, but if you look at certain fundamental factors and try to find consistent ways in which they behave, according to Dalio, you're dead before you start, because that's not the way markets behave. Markets will behave very differently, say, if you're in a recession than if you're in a liquidating depression type of economy. Same fundamentals will work very differently, and you have to understand that. Otherwise, you're just going to be completely wrong, because you're trying to force one model across different markets, and the markets are just more complicated than that.
We've only got so much more time left here. I know I can't keep you all day, but hopefully we'll make the best podcast. So when people want to hear about this book, this is where they're going to go. So let me get you to be teacher for a second on a principle that is featured around one particular trader, and I'll let you name him. But I think it applies to a lot of these traders, and it's a kind of a very academic sounding statement, and perhaps you can break it down. But asymmetric positive skew trades. That's going to take some people a little bit of time to sit down and kind of wrap their arms around, but it's an extremely important point.
Yeah, it is, and I love that philosophy of trading, and probably, I'm sure, it comes through in the book. So what does that mean? Well, to put it in plain English, it means that you put on trades that have the potential to make a lot of money, but even if you're totally wrong, they can't lose very much. Now, the simplest example of this is a long option trade. Now, a lot of people say, well, buying options is a mug's game. Options are overpriced, and you'll bleed money, and they'll do studies where if you buy options, always buying options, you'll end up losing, and all of that is true. And I'm using options only an example of how to set up a trade where you can make a lot more than you can lose. And I'm trying to also, in doing that, I also need to explain what's wrong with the way most people think about buying options. What most people really miss is that while on average, options have a somewhat of a negative edge, just like if you buy insurance on your home, the odds are, your house is not going to burn down, and the percentage, even across the whole population, home insurance buyers will lose money relative to the amount of money they collect in premium. And if that weren't true, insurance companies will go out of business. So that part of it is true. It has a negative edge. Okay, it's inevitable. Long options have to have a negative edge because you have to entice people to take the risk to sell you the option. Having said that, what the people miss is you don't have to be in the game all the time. The beauty of options is you can pick your spots. And if you can pick a spot where the market has a much better chance for having a large up move or a large down move at that spot, then options provide you actually a positive edge. But more importantly, they give you a way to trade that type of situation and have a very large potential on the upside while only risking a little bit on the downside, namely the price to the amount you pay on the option. So when some of the traders I've interviewed make a big deal about structuring their trades in ways where the upside is open-ended and the downside is very limited. Jamie May is one who's always does it, I think, on every single trade. Tom O'Shea does it for most of his trades. And the simplest way, is, as I said, is long options, but there's also being long CDS. There's other ways of doing those types of trades. But the simplest way, and the way applicable to most people, or the way most people can do it, is by being a buyer of options, but at the right point in time. The great thing about it is that it's a way of controlling risk, but still giving you significant upside potential. And it's one of the ways where these great traders, it's one of the ways in which they are able to get very good return to risk performance.
Yeah, I think it's terribly important. I think the first gentleman, whoever, you interviewed him in one of your original books, was Larry Height, was always big on this concept. He brought this up multiple times with me. So I saw that. I was like, that's right on target. Let me, like I said, as we kind of wrap up, I can't keep you all day. I know people like to listen to you all day. I know I can always learn. But in the rear of this book, it's really cool. And I can't go into all of them. There's 40 of them, and you call them your 40 market wizard lessons. And I think it's obviously you're taking all these great insights and kind of reducing it into something that helps to kind of summarize what's going on in this new book. I want to give you the ability, though, here to expand on something, because I find this sometimes in my work. I'll get readers and they'll see something and they'll think they found some discrepancy that I've written about. And I know I'm looking at number one, and number one is you're saying there's no holy grail in trading. I think most people can believe that's true. But number 26 is interesting, and I wanted to talk about this, the power of diversification. And you mentioned that Dalio says that is his holy grail to investing. So I don't know if you might want to kind of speak to, there's layers of how you're using that term.
Yeah, diversity. There are a lot of things that people kind of gloss over because, oh, well, yeah, diversification, that was important. But what I think people don't understand sometimes is how powerful some of these things can be. And one thing about diversification, and I use it in one of my other books, is it's the line, I think, something along the line of, it's the only free lunch on Wall Street. The thing about diversification, if you do it properly, it's a way of dramatically improving return to risk without really any negative to it, without any downside. And what Dalio's point is, if you have a strategy, and you pick your best strategy, and it has a certain return to risks, and that's good. But if you can find unrelated strategies, truly uncorrelated strategies, that you can increase your return to risk by as much as a factor, if they're really uncorrelated, by as much as a factor 5 to 1. So he sees there's a tremendous amount of potential improvement you can get in your return to risk, and it's all return to risk, not return, by diversifying. The way he does it is he finds ideas that have different drivers. So he's not paying attention so much to correlation, because correlations are misleading. They're backward looking. And you can have things that were uncorrelated can become correlated, or vice versa. What he prefers to do is to look at things that have different drivers. And if they have different things making the price move, then one should not be related to the other. And he puts together at least a minimum of 15. They have many, many more positions, but at the core, say 15 plus core positions that are completely unrelated. And that is one way he's able to get significant return while still keeping his risk in control. And diversification is something that applies not only to as a trader, but it's also when you're investing. And sometimes people talk about when you have a portfolio, say, of managers, and people will say, well, yeah, you put too many managers on, then you're diversifying the way you return. And I think that's kind of a very narrow-minded way of looking at it. Because if you only pick managers that you feel are approximately equivalent in their potential. I mean, you can always pick the managers that invest in the past, but going forward, you really don't know. So even if someone did better in the past, you don't necessarily think he's going to do better in the future. Or you shouldn't, because there's a very poor correlation there. So if you're picking managers you think have equal probabilities of getting about the same return to risk, then you should have more. You should diversify, because if they all have similar expectations, you're not reducing your expected return, but you are reducing your expected risk. So again, it has a lot of applications.
One of the things I did not set up here in the beginning is your process for how you selected managers. And you went about saying, okay, I want to target guys superior return risk performance. And I'm going to let you expand on that and how you went about that process. As you think about it, though, one of the questions I would have for you would be your definition of risk as you lay that out.
Right. Oh, well, that's a good stuff. Let's take that, and we'll come back to the process. The subject of risk, because this is one, and I mentioned that I have another book that I just finished writing, and in there I kind of have a whole chapter on this, but it's a whole confusion about what risk really is. Now, somewhere along the line, most of the investment community and a good part of the academic community, maybe most of the academic community for that part, has decided that risk is volatility. And the interesting thing, now sometimes it is, but the interesting thing about that is that you can have things that have very low volatility that are extremely risky. And in fact, their low volatility is one of the telltale signs of potential risk. It's not a sign of low risk. It can actually be a sign of potential large risk. And you can have things that look are very volatile and yet have very low risk. And I guess we can kind of give an example of each. So, and this is where people go wrong all the time. They look at track records and they look at, I want a guy who doesn't lose much ever and has, makes a little bit of money, and that's great. And that's great as far as it goes, but you have to understand where the profit's coming from. So a lot of hedge fund strategies make their money by putting on the types of trades that win most of the time, but every now and then the train goes off the tracks and you'll get clobbered. But if within their track record, that particular strategy has not had one of those episodes, it looks great. Now, the simplest example I can give you is a strategy like selling out of money options, okay? So if I were, in fact, if you wanted to be a charlatan in this business and kind of attract a lot of money, probably one of the best ways to do it would be you start a fund where all you do is sell out of money options. Way out of money options. Now, what's going to happen is, in virtually just about every month you'll be making money because the markets rarely go to those out of the money the strikes. So the markets go up or down a little bit, or even moderately, is making money. The only time you get hurt is if the market really has a sudden huge move. But the thing is, when it has a large move, you're not only losing money in that type of position, but you're losing money asymptotically, because those options you sold that moved 10 cents for every dollar the stock moved or the market moved now start moving 20 and then 30 and 40 and ultimately $1.
Watch out,
so
construction on road ahead.
Increasing at the same time you're losing money in that type of position. And what happens with these types of strategies is they get these strings of returns, which are very smooth, so low volatility. So the academics will look at it and say, oh, low risk. A lot of investors look at it and say low risk. But in reality, the process is one that has landmines planted sparsely. And it's fine as long as you don't step on one of those landmines. But ultimately, if you go far enough, you will eventually step on a landmine. And that's what happens. So that's an example of, and in 2008, of course, landmines were going off all over the place. And it was largely the worst hit strategies were the ones which had these low volatility, but high risk, what I call low volatility / high risk strategies. So that's an example of low risk, of low volatility, not only not being low risk, but low volatility actually being associated with high risk. The reverse side of it is a trader like Jamie May, who structures all of his trades, as we talked about before, to be rightward skewed, upside, and if he's wrong, he'll lose a little bit of premium. And there's a number of examples in the book about the types of trades he does, so we're not even going into that type of detail here, but it's basically the idea is that's how he structures trades. And what does that do? That means that when he's right sometimes, he makes these huge profits, and when he's wrong, he won't lose that much. So you get a track record that has a lot of volatility. But the thing is, if you look at the track record, all the volatility, not some of it, all of it is coming from upside. And so you have a situation where you have high volatility, but his process is still relatively low risk because he can never lose very much on any individual trade the way he structures a trade. So it's a very, very important point, this breaking apart these concepts of volatility and risk. They're very different, and people go wrong all the time by linking them together.
Do you want to, I only have a few more minutes here left, but do you want to touch on how you look at risk specifically, in terms of your measures? Sure.
I have one favorite measure, which I put in a book. I call it the gain to pain ratio. And it's actually, I kind of always assumed that it was kind of out there and people, but then I started searching for it. I Googled it and I found it was used generically, but I found that actually, even though it's a simple measure and in my mind, just about as good a measure of performance as you can get. If I only had one measure, this is what I would use. But oddly enough, it wasn't actually out there as a standard type of measure. The only place I found it in was in measurements of trading performance, where it's measuring trades, and it's something called the profit factor. And that is a statistic that's out there. And for your listeners who are familiar with profit factor, which is basically looking at the sum of all your profitable gains to the sum of all your losing trades, that is the same analogous type of concept, but it's applied to a trade-by-trade basis. However, taking it and applying it to time data, like monthly returns or daily returns, actually, it wasn't out there, and it's what I call it a gain-to-pain ratio. So what is a gain-to-pain ratio? It's simply this. You take, let's say if we're using monthly data, you take all the returns and just sum them. And then you take all the losing returns, only the losing returns, and you sum those and take the absolute value of the positive sign. And you take the ratio of all your trades to all your losing trades. And that's what I call a gain-to-pain ratio. And it's actually the one measure I use most heavily, and I can almost do without everything else. I just give me the gain-to-pain ratio and monthly data and daily data, and I really can't extract very much more out of the pure data. So the reason why that's so good, and it's why it's better than, I think it's much better than the standard measures. It's much better than Sharpe ratio, let's say, because it will only penalize losses. It doesn't penalize people like Jamie May who have large gains.
It doesn't penalize upside volatility.
That's right. It doesn't penalize upside volatility. It's much better than ratios like the Kalmar or ratio or ratios which basically take your returns to your worst drawdown, which is something I'm not a statistician, but I have a new about.